Good afternoon. This is Sean Golding with Golding and Golding, here to discuss a very common situation we come across often, which is when a taxpayer is basically fed up with U.S. taxes and they want to get out and formally relinquish their green card or renounce their U.S. citizenship. This is referred to as expatriation. Some websites make it sound easier than it is, or they don't really give you a good insight as to what may occur. So why don't we kind of go through the basics and a couple of hazards that come up often with taxpayers. Expatriation is the process of formally giving up your U.S. citizenship or lawful permanent residency status when you're a long-term resident, which typically means you've had the green card 8 of the past 15 years. Let's say, for example, you're a non-resident alien and then you become a U.S. person because you're on H-1B, E-2, E-3, and you meet the substantial presence test. Well, in a situation like that, when you're done, you leave the U.S. and you're not a U.S. person anymore. You get a sailing permit, tax term, IRS requirement, and that's essentially the end of it. Or you've had your green card maybe 3 or 4 years, same sort of issue. But for long-term residents and U.S. citizens, it's much more complicated. You're considered an expatriate, and you have to formally expatriate from the United States. You file a Form 8854. Depending on the type of assets you have, it can go from relatively straightforward to very complicated. And that's amplified for anyone who's considered a covered expatriate, since they may have an exit tax implication. Exit tax is not based simply on wealth. There's different analysis you have to do, but essentially, if you're a covered expatriate, it's no bueno. So in going through the expatriation factors, a few things to keep in mind is when you're going to exit the United States for good and you're considered an expatriate, few things to consider about the exit tax. One, mark to market. That's the most common. Assuming that there's no exclusions or limitations, you come to the U.S., you've been a green card holder for 15 years, you bought Tesla, when it was $5-10 a share, and now it's worth a lot more. And when it's time to expatriate, you have to pay a tax on the difference between what the value is when you purchased it, the basis, and what the value is on the day before you expatriate. Ineligible deferred compensation. Maybe you came here from Australia, you have a superannuation. It's extremely valuable at this point, and you want to expatriate. Well, depending on whether any step-up basis rules would apply or not, you may have to pay an exit tax on the value it's deemed distributed on the day before you expatriate. Specified tax deferred accounts. Maybe you have an IRA. It was tax deferred when you put it in, and then when you expatriate, it's deemed distributed on the day before you expatriate as well. All of these rules, depending on how you plan, depending on what your net worth is, if you're even considered a covered expatriate. But things to consider, it's not as simple as you're going to file an I-407 or for your green card, or you're just going to go down to the local consulate and take a renunciation oath. It's more complicated than that. Here are a few things to also keep in mind. Once you formally expatriate, you're considered a non-resident alien. Therefore, if you have U.S.-sourced income, you're still taxed on that. ECI, effectively connected income, typically get taxed at progressive tax rates. FDAP, fixed determinable annual periodic, it's typically a 30% withholding, although you may be able to reduce the withholding depending on whether you're residing in a treaty country. You make a treaty election if it applies. If you're considered a covered expatriate at the time that you formally expatriated and you had a 401k, you don't get taxed on the 401k when you expatriate. Okay, it's not deemed distributed. You may request for it to do that because you think you can get a better investment with that money overseas, but generally you're not required to pay the exit tax at that time. But in the future, you will have to pay income tax, and you're going to get taxed at 30%, which is FDAP. Now, several of the tax treaties reduce the withholding and the overall tax liability for items such as 401k, but when you expatriate and you're a covered expatriate, then you irrevocably waive the ability to claim that treaty election. That could change in the future, and maybe when the proposed regulations become finalized, there'll be some more wiggle room, but not currently. If you're a covered expatriate at the time you expatriate, and you're giving certain gifts or bequests to U.S. persons, then you can get taxed on that. The U.S. person pays a tax. It could be the 40% tax rate, and they'll have to file a Form 708. The Form 708 has not actually come out yet, and when those proposed regulations become final, the 708 should come out. It's similar to like the 706 or 709 for gifts and bequests. One final kind of takeaway, I see this all the time in my practice by attorneys who don't really do this for a living but kind of claim they do, write a few posts, write a few articles. If someone is a green card holder and they have been a green card holder for 8 of the last 15 years, then they are considered a long-term lawful permanent resident. Let's say someone's had their green card for 10 years and then they decide to go overseas and they decide to live in a foreign country, in a treaty country, and they can make an election to be treated as a foreign person, and therefore they're not taxed the same as they would be if they're a U.S. person. At the time you make that treaty election, if at that moment you are considered a long-term lawful permanent resident, that is considered an expatriating act. You can't unwind the expatriating act. So especially if you're going to fall into the covered expatriate category, it's super important. And one final thought. With being a covered expatriate, there's a net worth test, there's a net income tax liability test, but there's also the 5-year compliance test, which says if at the time you filed the 8854, if you are not considered to have been tax compliant for the past 5 years, that also throws you into the catch-all covered expatriate category. So something to be aware of. If you're looking to get into compliance before expatriating, there are various amnesty programs for taxpayers, depending on whether they have U.S. assets or foreign assets or both. If you're willful, there's the VDP, which is the Voluntary Disclosure Program. If you're non-willful, there are various options available to streamline procedures, delinquency procedures, and reasonable cause. We got a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate to your matter and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.